first rates any seconds now will just start, kicking in. Vodafone Idea 50% this year. Who would have thought that would happen? Okay, I can see the screen is moving. The first rates are coming up on your screen. It's a lot of green on the screen. Nifty, Bank Nifty, mid and the small cap indices, all of them are off to a great start. You got Inox Wind, where I think there is a block deal there. You can see it on the screen. 30 million shares, 31 million shares, 5% lower. Then I'm going to pick up the real absolute gainers, real absolute volume movers here. Vodafone Idea, Yes Bank, J Prakash Ventures, they all are off to a great start. Then you got Petronet, LNG and Reliance Power, they are also off to a decent start. Let me now mark the stocks in terms of volume. Like I said, a block deal, I think it's a sizable block deal I can see on Inox when we'll flash it for you. HDFC Bank, decent start. Reliance, holding on for the second day on the trot now. And Maruti post numbers surely has got re-rated in terms of positioning and in terms of appetite.
Yeah, absolutely. By the way, there's a CLSA note also in Petronet LNG, wherein they're maintaining a buy, target price of 270, earnings beat, but large petchem projects are seeing a derating worry. Management has suggested that part of this project may be a tolling style model, plus it exuded confidence from very high IRRs. Petronet LNG is really all over the place this morning. We'll give it a few minutes to actually digest and stabilize. In the meantime, lots of other stocks which are going to be in focus this morning. Let's check in on what Spandana Spurti is up to. Excellent set of numbers. PAT coming in at 116 crore rupees versus the comparable of 50. So you've seen a 2x jump on a year-on-year basis. That stock holding up 1% as we speak right now. DLF2, the collections have surged a good 88% year-on-year and 50% sequentially for a stock which has already, seen so much of a gain in a very, very buoyant sector. That is also holding up 1.5% as we speak right now. Marico, positive commentary from the management, upgraded the margin guidance as well. So let's check in on what that stock is up to, 0.5% higher there. And then, of course, there's TVS Motors as well. A couple of brokerages as well have come out with their notes, upgrading their price targets in TVS, good operational performance, higher other income, which is leading to a PAT beat for TVS, marginally higher for TVS right now. What's CG Consumer up to? Considering that merger with Butterfly Gandhimati seems to be off the cards for now, let's see what that stock is up to, 0.5% lower as we speak right now in trade. And then, of course, let's check in on the big movers from yesterday. BPCL, ONGC, Reliance. It was really all about oil and gas, and of course HDFC Bank as well contributing, moved up about almost 1%. Today too, you're seeing minute bit of those gains actually continue. Nothing meaningful though. And yes, that's a sizable, almost 10% equity which has changed hands in Inox Wind. That's quite interesting there. But for the index, it's a very quiet start, but no complaints here, considering from those Thursday's lows, we've made a meaningful almost 2% recovery coming in. Naresh, what are the first trades you're punching in? Anything interesting?
So continue to like ONGC, the stock is very close to a new 52-week high. So looking to add more above 192 levels.
All right. If we have Rudra with us, Rudra, let's get in your first trade as well as what you make of the market open this morning.
See, for me, we are opening right at the resistance zones in Nifty. Let it cross that 19,250 to 300 on a closing basis. In fact, all the long positions what I have taken last week, I will look at booking profits now. And for me, stock specific Adani Port is a strong one. One can look at buying Adani Port, looking at targets of 810 on Adani Port.
Okay, a buy on Adani Port. That's quite an interesting one. So not bad at all. We seem to have some stability coming back to the market. Not a rah-rah move, just about quiet, but with a positive bias. And considering the horrors from last week, we can deal with a quiet start. Mihir Vora joins in the studios right now. Mihir, hi, good morning. Good to have you on the show. It's literally Halloween today, and the horrors from last week still haunting us. But given the recovery that's played out and a meaningful comeback actually last two trading sessions, can we leave last week's horrors behind?
Yes and no, in the sense, first of all, I don't think the correction was any big deal. 5% from the top can happen anytime.
It was just really swift, so it scared you a little bit.
Corrections always typically are sharp, and nobody likes them. And even the mid cap and small cap indices didn't fall more than like 5%. So it was not such a bad thing. People, you used to making a lot of money in a short period of time, and frankly, the last 6 months, if you see the movement in the mid cap, small cap, and especially the micro caps, it was a vertical movement. So people are kind of conditioned to making money every week, and a couple of weeks of not making money, people are not happy. But I don't think it was any big deal. So having said that, there are risks in the horizon, and fortunately or unfortunately, most of the risks are global in nature. With the oil prices staying at high levels, not good for India. While we have managed the oil situation quite well by sourcing from different countries, but globally, I think we are in for a slowdown. Higher interest rates in the US and Europe are likely to stay for longer, and the situation in Ukraine and Israel is not helping. So there are risks, so there will be bouts of volatility, with the domestic economy continuing to do better than the global economy.
First of all, congratulations, new change. What's the idea? I mean, from a great franchise to another new franchise.
Yeah.
Pulse franchise is backed by great, promoters, the Seth family, VHR marquee investors.
Of course.
But it's still a fund. It's a new fund, and the Indian AMC market is very competitive. I've been told that there are 46 AMCs in India now. So why switch?
It's the passion and the joy of creating something. I've done asset management for long, so obviously it's my playground. And I think we can, with the promoter background and my experience, we can make a unique, combination of products and strategies to, to play around with. So, and yeah, while it's a crowded market, there is always space for, excellence, which is what I think we are going to stand for. More to follow.
So how many schemes would eventually you be coming up with?
It'll be a proper, full-fledged, active fund management house. So we'll provide whatever is needed for the customers. Not everything together. It'll be in phases.
So where are those unique opportunities in the market?
In terms of
No, in terms of where is it that you see investable opportunity in the market right now?
you're talking about a fund philosophy, or right now the sector and the
Yeah,
economy?
just looking at the market right now, sectors, bottom-up approach, any rationale that you may have.
So as I said, the broad premise is that the domestic economy continues to do better than the global economy, especially the places and the sectors where government has sharp focus on. So in the last 3 years, what we have seen is that while consumption has picked up recently, the government has been going all out to stimulate in whatever way they can, whether it's by spending directly on infrastructure like roads. We have seen good rollout in the last 3 years, but also by promoting various local manufacturing opportunities, defense, spending on railways has increased by 3 times. Our railway budget used to be 80,000 crores. They've hiked it to 2,40,000 crores. So I think the central and state government spending linked segments like infrastructure, construction, defense, railways, sectors where government wants PLI like manufacturing of electronics and durables. There are a lot of manufacturing opportunities there. Real estate is picking up after a while. So that is one sector we can expect. And even places like auto and auto ancillaries, we are seeing interest in PLI schemes.
Okay, so clearly investment-linked sectors is what you're talking about. And when it comes to financials as well, that's an area that you believe is likely to do well. Is it going to be cherry picking? Are we going to see the comeback of some of those large cap private sector banks that had taken a bit of a backseat? How are you looking at the valuation picture as well? Yeah.
Sure. So the thing is that if the domestic economy does well, then financials, especially credit growth, is typically multiple times that of 1.4 times that of GDP growth. So I do see a good growth in credit. So far, it's mostly been on the retail side. The corporate credit really hasn't even picked up. So once we see corporate credit coming, we can see maybe 15 to 20% credit growth. And with valuations for most of the private banks not really at stretched levels, I think there's scope for good outperformance even now.
So why are financials not reacting to numbers? Every financial, at least the big banks have come out with a good set of numbers. Small banks are showing a promise. Why markets are not going? Why rewarding them?
See, till about 12 months ago, you saw a huge outperformance of especially the private sector banks. So they're probably giving away some of that outperformance because it was massive. It was by far from the bottom of 2020 till the middle of 22. Financials were like by far the best performing sector. So obviously there's some time correction happening on that front. Plus, it was too lopsided in favor of banks, especially private sector banks. So that again was a double, outperformance. So now we are seeing NBFCs catching up, PSU banks having caught up in the last 12 months. So I think it's a bit of a sector rotation within the sector.
You've alluded to the fact that there are risks and or concerns, but all will emanate from across the globe. So do you think in light of that, India can remain resilient or isolated, or the India story still looks strong in light of all of these concerns?
Absolutely on a relative basis. But what happens is if there is a massive risk of environment globally, then we will not stay unscathed. There will be some impact, but much, much lesser compared to the rest of the world.
You know, Mihir, you were just talking about the entire infra theme. You were talking about the government capex, defense, railways, roads. Is there frenzy in that pocket, as we've seen play out with some of these segments without mentioning them?
Certainly, certainly. There is frenzy, and most of these segments happen to be in small and mid cap kind of,
Exactly.
so which is.
And they've run up so much.
They've run up
I mean,
so much,
over 100,
and you see
100% year to date.
Plus, the retail is chasing not only directly but through mutual funds. You saw small cap funds are the largest category where money is flowing in. I think I saw some numbers, almost 4,000 crores per month in small cap funds last month. So there is a bit of a fraud there. I would not belittle that, not ignore that, and probably that's why you see some sharp reactions whenever there is some concerns in the market. But if you look at, say, a 5-year view, it is a structural change. So best thing to do is the stocks are still good. Maybe the prices are not that good. So wait for your prices. Market always gives chances.
No, but would you buy railways? Would you buy defense? Would you buy these stocks? Let's say you get a 20% decline, 15% decline.
Certainly.
Would you buy them?
Certainly.
You think a 3 or 5 cycle, there is a valuation risk, no cycle risk.
Absolutely.
Okay. Where do you think there is a cycle risk? Where do you think markets are assuming that this cycle will continue to it for eternity? I mean, a couple of years ago, all of us thought that infrastructure will be an eternal cycle in India. I mean, when pandemic hit us, we thought digitalization will be an endless cycle for the world.
Absolutely.
I mean, I never thought that this kind of a contraction will happen for IT services, but it has happened.
Correct.
Where do you think markets right now are mistaking something what is cyclical as secular?
First of all, we'll only come to know in hindsight. But I think in some of, for example, the commodities stocks, especially say chemicals and specialty chemicals, markets are not building in normalized margins. Maybe the margin expectations are still very high, I would say. So there is a bit of a cyclical element which is not being factored into chemical stocks. Having said that, I would still play them for the volume growth. So the manufacturing in India for chemicals and specialty chemicals, and India taking market share like we did in pharmaceuticals, that volume growth story will continue, but probably we should temper down our margin expectations.
Veer, I've been wanting to ask this question, and I'm not going to get into trouble, but how much weightage do you give to brokerage reports which come every morning? Price targets, time period, how much weightage do you pay to them?
See, again, like in stocks, you need to be picky, right? You need to pick and choose. So there are some really good analysts out there.
Your favorite one is?
Will not endorse.
See, the mutual fund industry, now that you're part of mutual fund, is very simple. You cannot comment on stock. You cannot give a stock specific view. There is no restriction on analyst and a brokerage view, right?
No, but if you see my Twitter timeline, most of the quotes are from brokerage reports, So there is some really good quality work going out there. There are good sector reports, good thematic reports out there. So I mean, you should.
Which is a good report which you've read of late?
So there is one on the electronics manufacturing report that I read from Phillip Capital. They have done extensive work there. Okay. So there are lots of reports like that, and I keep quoting from those reports.
Narrow escape.
Here's something I know you will be able to answer. What about the election impact and Indian markets?
Election impact, of course, the views as of now quite one-sided. So if there is any negative surprise on that side, there might be some volatility around that. But we've seen that, over the last 30 years, we've seen different combinations. We've seen a super majority, we've seen coalitions, we've seen weak coalitions, and we've survived. So I guess it should be okay.
Right. Veer, what explains this exodus from FIIs? I mean, are these largely global concerns?
The biggest thing is that, you're getting 5% on the US 10-year bond.
Yeah.
So that obviously is going to, suck away some amount of risk capital out there. And the fact that when they go underweight China, they relatively need to rebalance the other countries also. So probably we are seeing some rub-off of that also, I would guess.
This China plus one has become almost like a fashionable word. Stationery companies which are going public now are telling me that, look, we are benefiting because cheap pens are not coming from China. Seriously. Cello gets 15% of its business from stationery, and another one, Flair, I think, is going public. And when I spoke to them, I said, okay, how come you guys are going public? Bola, China se maal nahi aa raha. Now what we are making in India is actually true. The China plus one is great. Atmanirbhar Bharat is fantastic, whether it is EMS or chemical or just about every major category.
Correct.
But Do you think markets are getting too excited about it? It's not that China is over, and it is not that India is where everything will shift.
See, the point is China is like 80% of the market in a lot of cases, or 90% even in some of the cases. You know, China's single location factory in some segments is equal to India's output in that industry. You know, so the scale is humongous. So even if we go from 90% China to 70% China, that's a trebling of demand. So that's the kind of opportunity we're looking at. I think our constraint is more execution rather than the opportunity out there. So if we make things easy, money will come in.
You know, I think manufacturing must not be even 5% of GDP for us.
For us,
Minuscule,
value. No, I would say manufacture about 15% of GDP.
That includes domestic and everything.
Of course.
Export, I was not referring to exports. Actually.
Absolutely. Yeah.
And for China, it's more than 40%.
No, we are, in services, we are close to 4 to 6% of global market share in services. In manufacturing, we are more like 1.5%.
So imagine if that doubles also.
Yeah, exactly.
Yeah.
Imagine that doubles also.
What about the weak links in the market? Will IT continue to remain in a slump? FMCG, rural facing, is that a pocket you should avoid for some more time to come? Although Marico was pretty gung-ho about what they're going to deliver next.
Correct. So you're right. In the sense, the Indian recovery has been K-shaped across, even within the premium segments, there is a K, with the super premium doing much better than the normal premium, so to say. So yes, FMCG is a weak spot as of now. IT, because of the global linkages, continues to be a weak spot. And global commodities like metals, etc., probably may also be relatively weaker.
But are they at the weakest point right now? Is this not the time to buy into those names?
No, global commodity, the steel stocks are not corrected that much.
No, IT, FMCG.
IT, FMCG. Look, pre-COVID, the IT sector was growing at single digits in any case. It's just that for 2 years, because of the COVID-linked, frenzy in spending, people suddenly working from home and shopping online and gaming online exponentially, companies realized they have to invest more in the digital infrastructure. Now, AI is a separate thing altogether, but if you look at that pent-up or that bunching of demand is now weaning off. And IT companies probably in the last 1.5 years over-recruited, for which they are now compensating, I would say.
So Mir, let's divide the conversation in two parts. First, what is a mega theme for next 3-5 years? Chalta rahega, right? I mean, financials, banking, consumer, like chalta rahega, treadmill. And then let's look at some exciting themes. For example, EMS is an exciting theme. EV was and is still an exciting theme. Correct. So give us one mega trend. And you cannot use financials and consumers here. We've spoken about them 10 years ago, and I'm thought we'll speak about them 10 years after also. So one big mega trend which is different, and 2 or 3 exciting themes which could be more like 2-3 year, 4 year, 2 to 3 year bets.
Sure. So one mega trend is, I think we need to go back to the 2000s, so to say, where the boom was really in infrastructure, real estate and manufacturing.
2003 to 2008.
Exactly. Okay. So and that was linked to some extent by a huge bump up in commodity.
Global commodity. China became hungry that time.
China commodities, China real estate. Yeah. So now I don't think it's going to be led by commodities anymore.
Okay.
So, but now we have seen that in 2020, China already has peaked out in terms of its population. Yeah. India, over the next 15 years to 20 years, India will supply 20% of the incremental working force in the world, which is second largest after all of Africa. Africa will, supply a little more than India, but India will supply about 10 crore people in the next...
skilled labor. Africa is not skilled.
No, population I'm saying. Demographics. Just demographics, not skilled labor. So India will supply 20% of the incremental working age population in the next 15 to 20 years. Working age population in the next 15 to 20 years. China has already peaked out in 2020, right? So if we provide the right conditions, and I think we are on the right track, like PLI, ease of doing business, etc., manufacturing has to come to India whether we try hard enough or not. It is for us to mess it up. We should not score a self goal. If we don't score self goals, I think there's a natural flow to India which will come in terms of investments, and that mega trend I don't think is going to change.
What about small trends? I mean, suddenly we are in a stage of the market where everybody is bullish on hospitality and hospitals both. Yeah, seriously. Hospital stocks have done well and hospitality stocks have done well. And the underlying theme here is that we will pay more first to consume and then if we excessively consume, we'll go to hospital. Just think about it.
No, the point is, this is only based on local demand, right? We haven't really even exploited medical tourism. I mean, if you look at the healthcare system out in the West,
Broken down.
it's atrocious. You know,
Atrocious and atrociously expensive.
Exactly, yeah. So India can supply so much of services for medical tourism, which is not even we haven't really scratched. But right now, even if you go to Gurgaon, for example, in some of the hotels where they have tie-ups with the Middle East countries, etc., rich Middle East countries, you see people, and they all come for medical tourism.
Is new age tech a no-go, or very selective opportunities maybe would be looked at?
No, certainly I would look at them, but new age tech is a broad term. There are individual business models we need to look at. No, so some of them have already grown to a scale where they can reap the benefits of networking effects. So there are companies with subscribers of 8 crores, with 8 crore active users or 50 crores actual subscribers. So those kind of companies would have networking effects which they can exploit. And that's franchise all done, and cash burn already coming down in a lot of those cases.
So network effect. So you're not looking at food delivery. You're looking at companies which essentially have a network effect. So that
Like
would include Paytm.
Yeah.
That's a network effect. Mir, I'm sure you've seen this data, but I got this data on Saturday when we were doing Investor Mahakumbh, and the data is that India currently has about 25 crore Netflix subscribers. The current users of food delivery app are about 30 crore, but the mutual fund investors are only 4 crore.
Such a shame.
Yeah. And
And
this
such
is
an opportunity.
This is when you've had the 10x multiplication in last 10 years in SIP. So imagine what you were 10 years ago, and where will you be 10 years henceforth?
You're making me feel good about my decision.
That was the idea. That was the idea. So good luck, and thank you for joining us.
Great, thanks for having
Every
me.
time fund managers they come on TVB say that what is next tip. So now that you're on this side of the mutual fund,
You can't. Great, thanks for
appreciate the
having
time.
me.
Thank you for
Bye.
joining us.
All right. That's the take coming in from Mihir Vora, talking about opportunity within investment-linked themes, also looking at sectors like financials. Tell you what, we'll take a very quick break. Stay with us. Corporate Voices lined up.
Okay, just a very quiet start to the trading day. Couple of names though which are really propping up within the mid and the small cap indexes. We're floating around that 19,150 print, but look at Pidilite for instance. That stock has jumped up a good 3% right now. A highly HNI dominated stock, or for that matter even DLF, which is delivered better than what the market was anticipating in terms of their quarterly numbers. A 2% bump up is what you're seeing on DLF. There's Canfin Homes holding up smartly, almost a 2% move coming in there. Chambal Fertilizers is up 1.6%, and then GNFC as well, which is seeing a move of about almost 2% in trade. But KPIT, that's been quite the dhamaka earnings. Let me welcome on board Sachin Tikekar, the President and Joint MD at KPIT Tech, joining in on the show right now. Sachin, hi, good morning. Good to have you on the show. A significant upgrade to your guidance. What's changed so much in the last 3 months?
First of all, thanks for having me and good morning to you. Things have been building up, to be honest with you, over the last 3 years. Nothing significant has changed over the last 3 months. It's just the consistency that we have built over the last 3 years that's giving us the confidence. And also what we have done in H1 of this year, Q1 and Q2, gives us the confidence that looking forward, it's time to revise the margin. The overall, just to double click on that, the overall growth is fairly balanced across all our practices and across the geos. It's coming largely from our T25 clients, and we continue to go deeper and wider with them. So that gives us the confidence to have a upward revision of the guidance.
You anticipating higher client spends because your margin guidance is still around 20%. So somewhere you must be also anticipating cost headwinds or investments perhaps?
Not so much of. So let me talk about what our clients are thinking at this point in time. Obviously, if you take the two aspects that are weighing sort of on the minds of our clients, one is the whole macroeconomic scenario, which remains dynamic across the globe. And secondly, the geopolitical situation. We have had one war for 2 years, and now there is another war. So there is a little bit of nervousness in the minds of the consumers and the OEMs. Having said that, most of the programs that we are working on for our OEM clients are long-term programs. They are for their model year 25, 27. Some of them are beyond 25, 27. These are important to them. And so that business continues to go very well. In that business, we don't see any headwinds in terms of pressure on the cost on us at this point in time. To your point, even though we have increased our guidance on the top line significantly, there is also increase on the EBITDA. However, looking at the kind of work that we are doing and that we need to continue to do in future, we'll have to make significant investments proactively to look at the trends that are upcoming that will solve some of the problems of our clients. So we'll continue to invest significantly in terms of building our practices and building our presence across the globe.
All right, morning. And I also wanted to understand, Sachin, what the outlook is when bulk of your revenue comes from PE. You had said that you'll be sharpening your focus further on commercial vehicles. What is the outlook for the near term?
No, it's a great question. Passenger car, more than 70% of our revenues comes from passenger cars, and we believe that will continue to grow in for the midterm for sure. Having said that, more than 28% of our business comes from commercial vehicles, primarily from trucks. And we need to go deeper with the trucks. There are a handful of clients that we work with. I think there is an opportunity where we believe that we can create value for some other clients within the truck business. That's point number one. Point number two, over the years, we have taken somewhat of for lack of better words, a tactical approach towards off-highway segment of commercial vehicles. It's time to go deep, understand their business problems, look at their technology challenges, and sort of tweak our technology offerings to solve their problems. So that's going to be an area of focus for us, and we believe that will also sort of complement our growth in the next 2 to 4 year horizon.
You earlier talked about that your deal momentum, or hinted towards deal momentum being strong, because $156 million worth of engagements were already closed in this quarter. Tell me, what's the funnel or the pipeline of deal wins looking like? Because there were a couple of large deals that you had hinted about, right?
The pipeline continues to be robust, in all fairness. The pipeline, depending on the kind of engagements that we close in a particular quarter, it goes up and down a little bit. If you look at the trend over the last 6 to 8 quarters, has been consistently going up. And some of the large engagements that we are able to announce together with our clients, some of them we don't announce. And some of them are not even structured as large engagements to begin with. But when we start to engage with our clients, they just grow substantially. And there are about 3 clients where those engagements have grown substantially without making it a really large. It didn't start off as a really large engagement. There was a roadmap. However, that visibility became more obvious to us over a period of time. And we believe that that's going to be the name of the game going forward. We'll do more of that with some of the OEMs that we are working with. Net, the pipeline continues to look fairly robust.
92 points higher for the small cap index. I'm just reading the screen here right now, coming back to KPIT, because the markets right now are seeing a lot of green, which sustains also, I think, is great news. The big picture for IT is that decision making is getting delayed. The order pipeline for the large companies is also solid. It is just that the translation, which could take months, has taken quarters now. So when you say the order pipeline is looking decent, is that just the visibility, or the conversion is also looking decent?
Unlike IT, where I think decisions are getting delayed, the discretionary spend is getting pushed out a little bit given the uncertainties. The OEMs that we are working with on the engineering side, especially in the mobility segment, we have not. The conversion also is reasonably good, and it's not just the pipeline. The conversion is also, we have not seen any kind of reduction in conversion so far. And we believe that it will continue. Obviously, given all the reasons that I talked about earlier on, we have to be watchful, and we are being very watchful. But right now, the conversion is on track as well.
Now, what about your headcount total at about 11,971? It has grown sequentially. Will the steady pace of headcount addition continue?
Yes, as we announced at the beginning of the year, we continue to do our campus recruitment. It's going as per the plan, and in H1, it's actually gone as per the plan, and we are very happy with the recruitment season that we've had on campuses. And in H2, it will go as per the plan. So there are no changes from our side. Every quarter, we'll continue to add people from campuses. That's part one. And part two, as we grow across the globe in our different centers, we also need to hire people with experience. That also is going as per our plans. So we are actually sticking to the plans that we made at the beginning of the year, and we don't see any change during the H2.
The industry has seen a huge first uptick in attrition, now the reverse, which is that there are no jobs, campus hirings are not getting honored. Talent is talent, right? And when talent is scarce, wage rate goes higher, and when talent is abundant, wages go lower. Could that be a permanent change in terms of the way you would be considering your wage hikes now?
You described it. I think that there are ups and downs, and we need to be cognizant of the demand and supply in the marketplace. I'm not sure about a permanent shift. However, to your point, what we've seen is over the last 4 quarters, at least 3 quarters, our attrition has been going down consistently, and we believe that in the immediate future it'll continue to be down. Our ability to attract talent, both from campus as well as talent with experience across the globe, has gone up substantially. And there are 2 reasons. A, to your point, I think generally there is a little bit of a slowdown in the market, perceived slowdown, or in some cases it's also real. And I think the way potential employees look at KPIT has also changed. So the perception of KPIT in the last couple of years has changed. That has worked in our favor to sort of attract the right kind of people. And as you said, talent is talent at the end of the day. We always have to remain competitive. One is the pay part, where we'll always be competitive. I think we have to take an inside-out view, and we also have to take an outside-in view when we look at compensation. The second part, we believe, especially as you go with people more than 4 or 5 years of experience, it's not just about the pay. I think when we speak to our people, we understand people are more passionate about our company given our commitment to sustainability. We are trying to truly live our vision of making this world safer, cleaner, and smarter. And that's something holds them back and keeps them excited. And with the fact that we are also doing cutting edge work with some of the best OEMs across the globe. So it's a combination of these 3 factors. And our initiative, which is Best Place to Grow, is actually anchored by these 3 things, competitive compensation, commitment to sustainability, and providing incredible opportunities for our people to make a difference for our clients.
Yeah, absolutely. And good luck with that, Sachin. Thanks so much for joining in today and highlighting what the quarter gone by has been and what is business going to look like going forward. 4.5% up on KPIT Tech as we speak right now. Quick break. When we come back, we're going to be chatting with the Strides Pharma management. Back with first trades right here on ET Now. Strides Pharma. Let me welcome on board the management. Arun Kumar, Executive Chairperson and MD at Strides Pharma, joins in on the show right now. Arun, hi, good morning. Good to have you on ET Now. And looks like your company is on track to deliver what you guys earlier promised. Get off some asset, reduce debt, and get OneSource separated as well. So suffice to say, would it be a fair assumption that you will stick by with your FY24 EBITDA guidance and net debt to EBITDA target of less than 3x?
Yeah, hi, morning, and thanks for having me, Aisha. Good to talk to you. First of all, conclusively, we have turned around the operations of the company post-COVID, so that's been a good outcome. And we have reiterated our guidance or outlook that we laid out in the beginning of the year. H1, we are on track to meet all those parameters. So we are comfortable in not only confirming that our guidance will be met, but in the case of EBITDA, we have moved it now to the upper end of the range.
Can you give me a sense of what is happening to the US generic market in terms of the pricing trend? Because that's been very hard to call for anybody.
Yeah, you're right, Nicole. But basically, we do have a slightly differentiated portfolio that we operate in the US, and that obviously constrains the size of our business in the US, but it does allow us the discipline that we need to achieve in terms of a margin profile. We do see one-off price challenges, but we do have a very large range of products that kind of supports our continued growth in the US. But having said that, price erosion is not completely gone off the US market. It continues to be a challenge, but it is a lot more rational these days, both from the payers and the supply group. So we see some level of, there was no more irrational exuberance on price, but clearly there is some rational views on how pricing has to be achieved in the US to maintain the kind of compliance levels and costs to manage that business.
When I speak to analysts, when I speak to some of your peers, I get this following sense that, okay, pharma, very few companies have debt. And Strides is one of them which actually has debt. If business is looking so strong, could you be looking at using your cash flows and start retiring your debt? Because then automatically your P multiple, your enterprise value, everything changes.
No, true. So, the peer group obviously has a very significant domestic business, which by default generates significant amount of free cash. Strides is a pure play export business. We grew our business in the last 3 to 4 years through acquisition, which obviously was done through debt. But since the last 12 months, we have set ourselves to reduce debt by over about 1,000 crores. We are on track to achieve that. We are meeting a guidance of under 3 times. We do not have any large long-term debts except for working capital. The pharmaceutical business has got a fairly long working capital cycle time. And with our guidance to be achieved for under 3, we are in a very comfortable situation. And as you suggested correctly, and also in our earnings call yesterday, our focus is to further reduce this. And we believe that in the next 12 to 16 months, this will further come down by another 500-600 crores from the free cash generation that we are delivering. Our goal is to be debt-free in the next 3 years, and I think we can achieve that.
Tell me, when is the likely launch of Vascepa, and how do you see this drug contributing to your overall numbers?
So Aisha, Strides had a boutique portfolio of very small products, niche products where there was limited Indian competition. We obviously, post the Endo acquisition of the Par facility and portfolio, we have upped that ante in terms of size. Vascepa is one of the first of the many products that we have filed and in the process of approvals, various other products, which will kind of take that size significantly higher than the $6-7 million average per product to now in the $15 to $20 million average. So to answer your point, we expect Vascepa to be launched this month. And in this quarter, we expect it to achieve it is constrained by supply chain and raw material availability. We do not have that challenge. So we expect that to be a nice outcome for us. And we have several more products in that range coming through in the next several months.
Okay, so morning, I wanted to understand as well how big the opportunities lie with GLP-1 contract business and what exactly is the plan here?
So GLP is part of OneSource, which is a CDMO division, which is in Stelis, an associate company of Strides. We currently have a very significant position with all the three GLPs that are currently commercial. Of course, they are constrained by patents and freedom to operate in various markets. We expect our partners to be in a position to commercialize the first GLPs as early as next financial year. At this time, we have a full order book, which takes 100% of our capacity in our drug device products division. But as you know, that there are several patents and litigations our partners need to overcome before we can become commercial on those products. Having said that, we have a marquee list of customers. Almost every key player in the global market is producing the product with us because there are very few players globally that have FDA-approved drug device combinations. So yeah, we're very excited about it, but it will be a slow start in FY25, and it'll reach its peak in 27 to 30 in that range.
And in the biologics business, I know there's businesses just starting out, but if you take slightly a little longer time frame, how do you look at the business evolving over the next 3 to 5 years?
So when we announced OneSource in the last quarter, we said that our order book will ensure that we hit $400 million of CDMO revenues in our biologics and specialty pharma division by FY27. We are on track to get there.
Thanks so much for taking time out and joining in and sharing with us the business outlook. So debt will come down over the next 12 to 16 months, net debt free in the next 3 years. There has been a positive turnaround as well. And the higher range of EBITDA is what they are targeting. A quick check-in on the markets. Where are we at? 19,100 being maintained. The broader markets are outperforming, up nearly 0.5%. Moving on then to the management of Blue Star. Joining in to talk about the earnings fine print, we've got Veer Advani, who's the Vice Chairman and Managing Director with us on the show. Thanks so much for taking time out. Mr. Advani, the strong growth in Q2 has been supported by the shift in demand. What is the current demand? What is the outlook on the festive season? Are you banking on even beefing up on the current growth that you've clocked in?
Good morning. Thank you for having me. Yeah, it was a great quarter. I think you saw revenue grow about 19% to 1,890 crores. And EBITDA grew quite significantly to 123 crores. EBITDA margin improved to 6.5%, which is where we would like to be and grow from there. You know that Q2 is typically a small quarter for Blue Star, but we were pleasantly surprised with the strong demand after a weak summer. I think you would have seen our segment 2 results. Revenue grew close to 40% and profitability has improved. So while June, July was certainly slow, we saw a pickup in August and September. Moving into you asking about the outlook and for the festival season, demand has been strong even in October, and we're looking forward to a very strong festival season.
You've reported, when you say strong festival season, well, the Dussehra is already over. So what has been the festival season so far?
So it has been very strong, actually. October has been good, better than expected. I think the industry is doing well, and we continue to outperform the industry. So we're looking forward to a strong Q3 as well. You know that we'll be building up stock in the market by December as well. So it is the Dussehra, Diwali, and then the build-up for the summer. So it looks like a positive outlook.
This erratic weather pattern this year played a role in how air conditioning sales have moved?
Yeah, absolutely. So you saw it's been a very bumpy ride, right? We saw a strong February, then a cool off in March and April, and then there was a pickup towards the end of the Q1, and then it dropped off again. So it's been very, very erratic, quite difficult to manage supply chain. But as you know, we have insourced and localized a lot of our production. And so our supply chain has actually shrunk from an end-to-end point of view. And so that has helped us manage our inventory and our receivables much better than we would have in such a volatile demand environment. But I do want to point out that while the weather has played havoc on demand, from an overall demand point of view, the outlook is quite steady. Consumers want to own an air conditioner, they need to own an air conditioner, and it is the item of choice, as and when they come back to buy. So from a long-term trajectory point of view, what we've been saying, which is that we're at an inflection point as far as the industry is concerned, we're very much in there and living it. Of course, the summer may throw some surprises at us every quarter.
When I speak to the entire sector per se, when I speak to some of your peers, they've been sharing the following, that look, inflation is high and consumer durable demand has been low. What you're telling me is a welcome delight and quite a surprise. So can I say that the consumer durable demand has bottomed out, or it's only applicable for Blue Star?
If you look at Q2, we grew about 40%, but the industry grew 30%. So I would not say that, the industry isn't growing. I think it's definitely growing. The outlook for the next couple of quarters is also good as far as the industry is concerned. So I would say perhaps that not talking about the overall durables industry, but about the air conditioning industry, I think that demand continues to be strong. You, of course, know that we have a very large B2B business as well. And I'm happy to tell you that demand on that front has been strong as well. So we continue to see inquiry levels at a very high level. We continue to see order inflow very strong. So I think it is the whole air conditioning and refrigeration sector and industry that is doing well.
Fair enough. There was a bit of a slowdown as well and delay of order finalizations in the commercials building sector previously. Has that continued? Has that stabilized now? What's the outlook?
Yeah, so we'll talk about segment one. As you know, it's a large segment for us. You saw about a 12% growth in revenue, and margins were flat at about 6.1%. So what's happening there is that it's largely positive, but I'll just throw some more color on that. The commercial real estate market has been slow. We also are not too keen to add orders in that segment because we've been seeing challenges around cash flow there. So as a company, we have redirected our marketing efforts into new verticals outside the commercial real estate market. So that's as far as our projects business is concerned. Our commercial air conditioning equipment business, I think there we continue to serve the light commercial retail markets across the board. So I think from an equipment point of view, demand has been strong across even in government buying as well as in infrastructure. So I think it's just the projects business where we're a little cautious about cash flow in the commercial sector that we're seeing a little slowdown there.
Now, my next point is that you've raised capital, and I've had the business of I've tracked Blue Star for years now. They've never raised capital, but couple of quarters ago couple of months ago actually, you've raised capital. Why have you raised capital? Because in your history you've never raised capital, but you've suddenly raised capital.
Sure. So thank you. So it is a once in a generation fundraise. I'll say that. And the reason I say that is that we've raised 1,000 crores from marquee investors just last month. We did that because as I mentioned, we are at an inflection point as far as the air conditioning and refrigeration industry in India is concerned. There has been a push by the government to localize and indigenize, as you're aware. There's a PLI scheme that was announced, and there have been import duties that have been raised in our industry. So we have demand growth on one side, we have a supply constraint from imports on the other side. And so it is essential if we want to participate in this expected growth that we anticipate, that the company makes suitable investments in the back end. So what do I mean by that? Investments in R&D, both in people as well as product development and testing infrastructure. So there's a big piece there. There's investments in manufacturing. We're growing our capacity quite significantly, not just in room air conditioners, but in deep freezers, in commercial air conditioning equipment across the board. So there's manufacturing capex required. our business is becoming far more electronics intensive. And so there's a big investment required in digitalization, both of the product as well as our processes. And of course, we continue to spend on the brand. Now, the brand, of course, will be funded through internal accruals, but from a CapEx point of view, it is manufacturing, R&D, and digitalization that we anticipated we need money for. We could have funded it through bank borrowings and internal accruals, but I think there would have been a mismatch between when we required the money versus when the returns would come. And so not wanting to stretch the balance sheet too much, and looking at the global uncertainty of the financial markets, we decided to raise money ahead of that. So we're extremely happy that we've done it. We did it at a good valuation, and we're very confident of giving very handsome returns to our new investors.
Great to have you on the show. Thanks as always for taking the time out and speaking with us.
Thank you.
Okay, let's move on. Let's address what the market has been up to. It was sure a quiet start, and from there, that little bit of a pickup has gotten sold into, and we've drifted now into the red, just marginally so. Pressure points being Petronet LNG, ONGC, Marico. Good news is actually getting sold into. But Naresh is back with us to identify some of the trading strategies. And Naresh, let's start off with your chartbuster idea.
So starting off, the sector which has been looking good is NBFCs. We've seen OG1 do well, then we had Equitas do well. We saw Spandana Spurti also make a breakout, and the next one making a breakout is Satin Credit Care. The stock has made a base around 200 levels, the last two bottoms around that area. Sharp spikes both the time. In the last 2 days, it has seen very strong volumes, a short-term range breakout done here. A target price of 270 to 300, stop loss to be kept at 230.
Naresh, that's your chartbuster idea, but what about your individual stock picks?
So two stocks for a bounce back trade. First is a buy on Tata Power, which has corrected quite a bit from the highs. Started showing reversal signals in the last 2 days. Stop loss at 235, target price of 255. Second is Apollo Hospitals, which is back to the support area and trying to make a reversal here. A stop loss at 47.50, target price of 5100.
Thanks very much for those chartbuster calls. Very short break, and we'll see you on the other side. The Nifty at 19,116.